This meeting is being recorded.
Got it.
Hello, everyone. Welcome, welcome, welcome. We have our wonderful Bradley Jones here today to talk to us about student housing. You know, there's lots of different kinds of multifamily out there, and everybody thinks about apartments, but student housing is different. And if you happen to have children and you're going to send them off to college, you might want to listen to what Bradley has to say. So thank you, Bradley, very much for coming on. I know you're not at 100% yet on your health, but we are so thrilled to have you. And please take it away.
Okay, I definitely will. And I apologize in advance if I am coughing or a weird cough comes out, just act like it didn't happen. Okay, so let me share my screen. There we go. Okay, so make sure everyone can see my screen. So again, I'm Brad Jones. I am managing partner of Standard Normal, and Tintagle is a fund of that Standard Normal. It's the real estate division of Standard Normal. So Standard Normal really is an investment firm with three funds. We call it a family of funds. There is a VC, a fund, a hedge fund that trades electricity, and a real estate fund. A little bit of background about me. Again, founder and managing partner of Standard Normal. I went to undergrad at University of Colorado. I have a bachelor's degree in economics and physics. And I was drafted into the NFL in 2009 and played 7 years in the NFL with the Packers and the Philadelphia Eagles. After I got done, 7 years in, I got done. I spent a year and a half at Harvard's Grad School of Arts and Sciences, studying statistics, majorly concentrating in statistics, and then jumped over to Harvard Business School for a graduate program at the executive ed program. So once I got done with that, again, spun up Standard Normal in Tintagle specifically to do our real estate investing. I want to talk a little bit, I think first about Tintagle and kind of who we are. So Tintagle, it's an $30 million investment fund, but it was traditionally invested in multifamily assets, just traditional value add multifamily. But I think what makes us different is that we're seeking now to do more micro investments. We think that the true alpha and the true returns that you can get, the 15, 20, 25% returns are going to come from sub $1 million investments going forward. We think that the space at the $10, $15 million level is crowded. And we think going forward, like our other funds, we are trending smaller and smaller and more frequent investments. And I think that's a lot of why we're here today. So again, what makes us different is first and foremost quantitative analysis. Everyone here is really quantitative minded. We take a algorithmic approach to real estate investment and stakeholders within our real estate investment practice. It's all quantitatively mapped, just similar to kind of a professional sports team. Think of a team of statisticians who are constantly analyzing people's performance and portfolio of investment performance. So again, a little bit about our method. It is really a two-step method for our sub $1 million investments. It is macro analysis. So first we start with a quantitative analysis of the entire country, every county in the entire country, 3,143, to find quantified areas of interest. And we use about 7 data sources. So power grid data, urban footprint Yardi, IPUMS data, and census data. And we try to find, an example here, quantified areas of interest are going to be Southwest, Lower Midwest, Carolinas, and reasoning is usually persistent or exponential increases in population and or disjointed locational wage growth. The types we're concentrating on are student housing. The second method or second step of the method is institution analysis. So within those counties that have universities in our areas of interest, we do another analysis on the institution itself. So we take, data sources are really four main ones, and this is kind of the majority of what we look at, is the endowment investment data, the graduate school data, the public university enrollment data, and FAFSA data from the government to figure out really the proportion of low-income students who are applying or enrolling into these universities. And we think it gives us a more granular look, really outlook for student housing in that area. And so I want to kind of get this across to make sure everyone understands it, is that our business strategy really is this. This kind of sums it up the best. There's a fair market value everywhere, and that'll be this line. And the fair market value, is going to wobble around this line as the years go. It's going to ebb and flow above or below that line. Technically, this line will kind of be a trajectory going up, but this gives a good idea. We only pick properties that we can, for some reason, artificial or natural reasons, it is below fair market value. That's it. We target specifically, usually, early operators and or operators who have gotten over their toes. So operators who took out bridge loans that are too much, that are shrinking all the profits away from the place that they own, or construction loans that were actually too much, or they took out too much, that they wind up being in a bad spot. So most of the time, these operators are going to lose money anyway. We are essentially the saviors for them. It's usually for them, it's the difference between losing, let's say $500,000 and $100,000, which is just a great deal for them, but it's an even better deal for us. And I think that's the most important piece of what we do, is that we are very selective, and we will only pick properties that fall below this line. So all of our properties naturally will have a reversion to the mean. It will revert to that fair market value at some point. And so all of our modeling is really based on that, is that it will revert to the mean naturally. Now, our modeling saying, modeling out the demand for the university, so the increase in student body population, the wage growth of the area, the population growth of the area, will turn this reversion to the mean into an exponential increase. So we are not necessarily value adding our properties. We are doing it from a quantitative model, if that makes sense. We're below fair market value. We will revert to the mean, but based on our modeling, we have an expectation to revert to the mean even farther, to exponentially cross that mean. Okay. Oops, excuse me. So here's our past performance. Investment highlights, really. Oh, excuse me. On average, we usually take around 50 to 66% to 98% occupancy improvements. Average rent usually is around $1,800, but it's a little strange because we do student housing. So, and I'll get into this a little bit later, but we're renting usually by room, not by unit, or excuse me, not by property. Our average LP-GP split is usually 80-20. Our average hold times are about 4 years. 11%, our Philadelphia property, I think, was the sub 1 million, the worst property kind of we've done at 11%, but we've had fairly good returns, again, 15, 18. We've exited out of everything outside of our Ann Street property, which is currently at a 23% return, but we'll keep that. We'll keep refinancing because it is a rock star. Okay, and let's say, okay, so student housing. What is student housing? Again, this is my favorite. This is my favorite thing. I am born and raised in East Lansing, Michigan, so I was raised in student housing for my entire life. A lot of different student housing, but for my entire life. So student housing is really just accommodation that's outside of the university. So most universities typically don't have 4-year guaranteed housing. So once a student comes in, is going to do a 2 or 4 year degree, they are locked in there. And so what they're doing is just really looking for, close proximity and or easy access to the university. And that's literally all student housing is. It can be undergraduate or graduate, whatever the model you want, whatever you're targeting. It can be either of those. Okay, so why to student house invest or to student housing invest? And these are important points, so I kind of want to take a little bit of time here. So compared to the regular housing market, student housing markets are a consistent flow of renters looking for housing throughout the school year, even summer months. And what type of student housing you're targeting, you can kind of build your models any way you want. Because of this, there's a high demand. Like I talked about, most universities 4 or 2 years do not have 4-year housing for their students. So they just don't have the inventory or the capital means to create those houses and to maintain those housings. So millions of students every year, the overwhelming majority of all students on all campuses are looking for housing that are close to campus, that have nothing to do with the universities. Because of this incredible demand, the rents are significantly higher. The high demand for housing means high rents. I mean, it's as simple as that. Once students, like I said before, when students decide to spend 4 years pursuing a degree, they have to live somewhere. They have to live on that campus. So it is easier for us to make a one-to-one correlation with the enrollment practices of the university or their degree programs and how much demand there will be for student housing. Then we can take the current suite of housing that is in that usually 2-mile radius, and we can come up with a kind of a fair market value for our expectation of rent. And it's an easier process than you think. As administrations increase their degree programs, or they add in new ones, or they increase enrollment, you can see it. And if you look back, historically, you can see the one-to-one correlation in the increase in rents, because I think a lot of people assume that as digital infrastructure gets in place at all these universities and online enrollment increases, that it diminishes the in-person experience at universities. But what we've seen, and the huge body of research we've looked at, it's actually counterintuitive, because there's a higher demand that gets placed on being in person at a university. As universities open up their online programs to tens, sometimes 20,000 people, that the accommodations for in-person learners goes way up. The enrollment rates go up, the competitive enrollment rates go way up. And because of that, usually higher net worth, or I guess more affluent students, wind up getting those slots in universities, which again pushes rents higher and higher. Also, for universities, I touched on it before, you're not renting to a building, you're renting rooms. Usually students aren't looking to, you're not coming in like a single family, a mom and dad with 2 kids. You're renting a typical room or typical unit that would have, 3 bedrooms, 3 baths, that would rent for $2,000 a month, is renting for $700 per room, which is, again, almost 40 to 50% increase in the revenue that you could have with the same unit at the same location if you rented to a single family. Again, I think most people sway away from student housing because they see young kids. They see 18 to 25-year-old kids, and they're nervous. And this is a picture of the offering we're going to talk about a little bit later. But from the guys who live there, and I think the most important piece from a security standpoint is that you have co-signers that guarantee the payment. And if you look at it, again, model all your investments, you wind up having less trouble with student housing renters because of that. That you're not really transacting with a 21 or 23-year-old kid. You're transacting with a father who has worked at IBM for 20 years. He guarantees that damage, guarantees that rent. And the kind of the gold standard here is the organizational lease renewal. So especially, again, among social groups, sports teams, fraternities, sororities, and certain homes or areas on campus are especially desirable. And again, this is usually because of the location of the house and the space or access it provides, and or the sentimental value. So even among Greek-led community, it's extremely popular for the next generation of their brothers and sisters to live in the same house. And so you wind up buying these houses and properties that live on in their family for 20, 30 years. And I want to stress this as well. Student housing is, it's an operating business more than a multifamily business. You are, depending on your models, organizing leases that sometimes go multiple years in the future. And then those leases that are signed for multiple years in the future go for multiple years, go for 3-4 years. You're signing very long-term leases, or you're signing extremely short-term leases, sometimes semester and half semester leases. So there's an operational weight that, that's carried with student housing. And these are the guys who are looking at Freeman Street. So what we found here is kind of the holy grail of the kind of type of property that we've been looking for. And that's 408 Freeman Street. It is in Carbondale, Illinois at SIU, right on their campus, right next to the campus. So it's a 10-bed, 3-bath housing residence with Alpha Gamma Rho fraternity at SIU. Alpha Gamma Rho is the agriculture and animal husbandry fraternity. So it's been described really as the most boring frat house in town. There've never been any issues and complaints. It was built in 1987. It's a fantastic location. It's right across the street from the university, but really university is located on the other side of the street as well. So it's adjacent to the university. So the beauty about this is that the lease is contracted directly with the Alumni Association for Alpha Gamma Rho, who also has expressed interest that they would like to buy that fraternity house once they can get their coffers increase a little more within the next 5 years. And so they pay full contracted rent every single month, no matter how many students are subcontracted in the house or how many brothers are subcontracted in the house. They only place upperclassmen, and they have huge standards to try to get guys academically in there. They pay their own utilities, their full responsibility of all damage. There's been no incidents in 10 years caused by students. And again, they've been fantastic tenants since 2012, and they're already contracted through 2024. They're the animal husbandry fraternity, so they don't really spend a lot of time in the building. Again, it's ideal that they pay exorbitant amounts of money that's really not on the brothers, it's kind of on the Alumni Association to pay that. And again, fantastic. And these are some pictures of the guys, so I guess everyone can get an idea of what they look like. They spend, again, majority of the time here with cows, and it's a whole thing. I think Peggy has a little experience on farms, so she can maybe shed some light on it. The investment opportunity here really is a small one. And I want to speak on this a little bit. It's kind of what we're looking going forward for the next few years, is that we want extremely small, again, more micro investments that we can target returns in the 18 to 25, even higher ranges. So this will be a single family home, again, 18 to 22% IRR. We see really 2.3 to 2.5 estimated LP multiple. In the project type, again, student housing, we're doing preferred return at 10%, and the projected hold time is 5 years, but really 4 to 5 years. I think there's a refinancing opportunity, possibly at 3. And again, the equity raise is small. It is $100K, but we're coming with these programmatically from now on. We want to do 1 to 2 of these really per month. And try to build, I think, more programmatic relationships with investors. We think that that's going to make more sense. We think also it makes more sense from an investor standpoint, in that investors, instead of having be invested in, let's say, 3 or 4 or 5 properties, you have the opportunity to be invested in, let's say, 20, and you have the ability to, because our equity raises are so small, to cash out of those investments anytime you really want. So if you say, you're invested $100,000 across 20 properties and you want to liquidate 20K of that, because our equity raises are so small, we have the opportunity to buy investors out of their stake with really no fuss from us. Time to close for us is around 60 days. And again, just kind of quick general plan is the cash flow is going to be it begins year one. Estimated returns are going to be around 20% per year. 20% IRR. Estimated return on 100K, again, for 5 years is going to be around 148. So that is, 240, $100,000 will turn to $248,000 in 5 years. Minimum investment is going to be $10,000. GP, we're coming in with $20,000. Again, every single investment we've ever made, we make sure we take between 5 and 20%, sometimes more, significantly more, in every investment. But there's no investment where we're not invested. My own personal capital is not significantly invested. It never happens, because we've done extremely well, and we're not in the business of losing money. And so I would like to make money alongside of everyone here, or anyone who's interested in investing. Yeah, so by the numbers, this is kind of what it looks like. So we're going to do a purchase price. It's going to be really small. Again, 271, closing costs, 15K. I'll get outside of that. But here's the interesting part is that, we're charging really $3,800 a month on a property that costs almost nothing. We put really conservative estimates of kind of 10% repairs and maintenance, $4,500 repairs and maintenance. And historically, if you look at their T12 and even T24, that's not, again, they take ownership of all those repairs and maintenance. So when we underwrite these things, when we model them out, we try to make everything extremely, extremely, extremely conservative. And so with our conservative estimates, we think we can get to a 20% IRR. But again, like I want to make sure I get this across, is that when let me go back for a little bit. As we're picking these properties, we're able to get this property because the operators that we found took out a loan that's around 25 to 35% interest. And even with their return, it's basically zeroing out all their profits. So for them, they have the opportunity to, okay, are we going to lose money for 5 years, or are we going to allow someone else to maybe come in and take this property at a discount and then make us whole so we can go out and invest in other things? So the appraisal value that was appraised last year was 325. So essentially, we will have a purchase price of 271 at the end of day one. After we close, that property is worth $325,000. And I think that's where we do magic. Again, we don't typically get in for the sub 1 millions. We don't get into the value add. What we add is quantitative skill. We pick, as a true portfolio theory, we pick properties that are going to revert or going to grow regardless. And then we make assumptions based on what the university areas are doing to say, can we increase that return based on those things? So why this fits is that SIU is going to have a positive student body growth for the next at least 5 years. The administration has publicly stated that and is committed to that for the past year. They said they want to grow their student body by at least 50% over the next 5 years. And so we assume statistically that the increase in student body will lead directly to an increase in demand for housing that is close to campus. Now, this close to campus housing will be fraternities, sororities, and just any houses within 1 mile of walking distance of SIU's campus. Secondly, there's multiple opportunities for exit. Again, we have a simple 5-year hold plan. We're just really capitalizing on the disjointed price that we're getting for the 271 to 325. But because that there's such a jump there, that there's an opportunity to kind of refinance and possibly hold and turn this into an annuity for the next 5 to 10 years. Additionally, I think this is a really important point, is that there's lower than average FAFSA applications by the student body. So what that means really is that, of all FAFSA applications across all major universities, there's a median number, and SIU, which you wouldn't think, has a 30% lower FAFSA application than let's say Chicago, or University of Illinois, or Chicago or Loyola, which means that technically higher, more affluent students are applying there than the median number. So that again translates directly to higher rents. We have slightly higher average incomes for households. Their children are going to this university, and regardless of where that university is, we'll be able to capitalize that in the rent. Yeah, and so again, I want to just jump back here. So that's really the whole plan. But I want to jump back to make sure everybody understands this picture while I ask her questions. Okay. Right. Yeah, and so again, so that's what we're looking for. We're looking for $100,000 again to do this project, extremely quickly, and then come back and do again another one the next month, another one the next month. Again, all student housing, all kind of targeting the same 1 mile distance from major universities that have either low FAFSA, increase in student population, and or both. That's us.
That's it.
That's it.
Okay. Thank you very much for that.
Of course.
I just want you to know that your 15-minute presentation is a tiny bit longer.
Oh no, what was it?
I know you were like, we won't be 20 minutes.
Oh, I didn't think I would go.
It was 25 minutes.
Oh no, I apologize.
No, it's great. We like the explanation. We want to know.
Yeah.
So we're going to go to Q&A as we do each week with each of our speakers. And this is a subject that has not ever been brought up before. So I would imagine that some of you have a lot of questions, and Seema has the first one. And Brad, could you quit sharing screen so we could see everybody?
Of course. Let me stop sharing.
It was a great presentation. Hi, Seema. Happy New Year.
Seema, you're still muted, I think.
Yep, she is.
There you go.
All
Now?
right.
Oh, good.
Here.
I've been avoiding the human race, so that's why I haven't been on a meeting yet. But I had asked. Cliff told me what was going on, so I wanted to go. I wanted to jump on this. So that's this is something I've been thinking about. My daughter had gone to Cornell. And a friend of mine had said, this is much after she graduated, that we should buy houses in Ithaca because it's but the whole thing of like managing it, I'm too old, and there's no way that I can even find people to manage it. So this is good that you have like a group or a fund that can do it. And Carbondale is a good college. I mean, I know, I usually know what are okay colleges if I know Indians have gone there, kind of thing. That's how I do my, I hear of them. Now, how do you find out about the what's it called, fascia? How do you find out about? So is it common knowledge?
No, it's not common knowledge. Again, so I think because we started as a hedge fund, what we constantly do is look for unique sources of information that we think will correlate to, that we hope will correlate to either increase and decrease in the model that we're plotting. And so, no, it's not common knowledge, but we had an idea one day to check it out and see if that worked. And it did. It was a pretty big correlation. So it was like a 0.73, which is ginormous.
No, that is brilliant because, and again, I was, like my other daughter went to Georgetown, and I know that there the kids who go to that are, some of them are really ridiculously rich, and their legacy and the reason is, I gave Cliff an example that while my daughter at Cornell, even though she had no issues with money, but she was drinking what was it? Gosh, I forgot. But she was drinking the cheap stuff, whereas my daughter at Georgetown was drinking bourbon that nobody in our family. Keystone beer, right? Just crap. And and nobody no woman in our family has had bourbon whiskey kind of thing. We were so shocked when she came home. So now when you say it, I can relate to that, and it's really cool that you can find information like this. So that was all. I am looking forward to it.
Yeah, no, as an aside, my sister is currently getting her PhD at Cornell. And we own a few properties out there, a farm out there called the Learning Farm out in Ithaca. So I love Ithaca. As a side note, I love Ithaca, period.
Yeah. Thanks.
Sure.
Well, thank you, Seema. Well, I have a couple questions if nobody else has any.
Of course.
And I like to spark people's interest. So you use the word mean a lot, and you said that you're buying these properties at this lower amount and it will rise to the mean. Could you explain what that means to the group here?
Of course. So again, I'm going to share really quickly again, just so we can look at the example while I'm looking at this. So again, what we try to map all these things visually, because all I really look at all day is just these huge data sets. And so we try to make these visualizations to help ourselves and other people kind of understand it. But what we tend to say is the fair market value is it depends, usually the median or mean, so the average, just say the average price that would be fair across like a 5 or 10 year timetable. So as it wobbles up and down, there's a true fair market value based on all these averages along the line. And we know that the real price of it will go up and down and kind of wobble around this line. But it's going to be difficult for you to ever actually land on this line or what the true average is. And that is the average. That's the true fair market value, what is right in the middle of all the ups and downs. And you want to think of this also, and I wish I could rotate my screen. Really, the fair market value is going to be a diagonal line that's increasing. So from really from here to here, and that line is going to wobble still around it. But that's the median, the mean. That's just the average. That's all we mean. The true fair market value. But what we're trying to do is we are purchasing properties that are only below this mean. We know this line, it's lifespan of the property is going to go up and down and kind of wobble around this line. We know that. What we're only doing is buying properties that are artificially or because of outside reasons have fallen below this fair market value. So the property in Carbondale here, this fraternity house, is fallen below this line only because the operators purchased that building and they took out a loan that was over their toes. There was way too high of interest rate and they thought that it would still be profitable. So we're able to get that building at a price that is far, far, far below fair market value. After day one that we get this property, it goes right back really to the fair market value. And if we model it correctly, then the increase in student body population, the more affluent students that are going there will push this from the fair market value even farther to way up here. And that's what we bank on. It's what we've kind of done for all of what we've tried to do for basically all of the properties. So, 605 Whittingham, again, it was an operator who couldn't get a roof repaired, or there was some damage. I can't remember, but they had a death in the family, and no one would take the property off of their hands because they wanted 6 months time to let their family stay in the house and then sell it. Again, we came to an agreement where we got a pretty significant reduction in purchase price to allow them to stay for that 6 month period. But because of that, we have this disjointed jump. And then we sell this property to graduate students from Michigan State University. And because the graduate programs we were targeting were increasing their student body population, we got to capitalize all of that in the rent. Again, I want to really harp on that, is that it's counterintuitive and it's unique, but we don't really get into the value add space under $1 million. What we do is we just target, again, by artificial means, properties that we can purchase below that fair market value. And then we know, again, if everything goes wrong with our modeling, we will still return investors our money. Now, if our modeling is right, we will return that money at a significantly higher pace than anyone else. But again, we're not targeting value add. We're targeting just true statistics of the area, of the building, and of the university.
Thank you. So when you're looking at giving their money back, you would do that by a refi. Are you looking at where you think that the one, economy, two, interest rates? I mean, what do you take in mind when you say on year 3, we think we should be able, and we got that we think we should, means that that's not necessarily a given.
Well, we will be able to refinance in day 1 because we're purchasing a building that is worth $325,000, and probably we'll get another look at that building, but we'll probably significantly more than that. From day 1, there's a ton of equity in the building that is already ours. What we're saying is that possibly in year 3, interest rates may be at a place that it is exponentially better for us to refinance. We could refinance this building technically at any point from day 1 to day 10 to doesn't matter. We could refinance it constantly because we have a ton of equity in it. But our plan, and always the plans that we present, are the most straightforward, conservative plans. Because if those can be profitable, then we have tons of room to do other things to juice the returns a little bit more. So refinance, and we'll talk to all the investors and say, does a more refinanced annuity play for a longer term period? Is that what everyone's interested in? And if so, then we can alter or change our plans. But we come with straightforward, easy to understand plans, 5-year holds, and we just target these points that are significantly below, market value. That's it. Yeah. So long story short, we could refinance, if we wanted to day 1. We are immediately coming into a property that we have $50,000 more equity in.
Yeah, that's great. I mean, yes, Ted.
Sounds like you're looking for essentially distressed owners or sellers.
Yes.
Primarily in what would otherwise be economically sound geography.
Yes, exactly.
Yeah.
Exactly. That's exactly what we look for.
And presumably then you have an exit strategy mapped out at the point of purchase.
Yeah, at the point of purchase, absolutely. Exit strategy is mapped out.
Okay.
Mm-hmm.
One of the things, probably a little bit off subject, but one of the things that because I lived in a fraternity house when I was in college.
I did.
One of the best jobs for a retired person that I have always been able to imagine is that of being a fraternity, the equivalent of a fraternity house mother.
Mm-hmm.
Do you expect that, let's say, dwellings like this, let's say be occupied that way, or because it seems like house mothers have more or less disappeared out of the fraternity houses, I think to the detriment of the residential system.
Yeah.
Are you trying to do any more, let's say, social engineering besides just being a landlord?
So we're not implementing any house mothers for Alpha Gamma Rho fraternity themselves. Their operation, as far as what Alpha Gamma Rho is, their society, we don't really step into that. They don't currently, from all our diligence, they don't currently have a house mother. In all honesty, like I said before, they spend very little time at the fraternity house. They live on the farm. They're milking cows and breeding cattle mostly, and then going to class. But no, I wouldn't step in.
Iowa State University, so I'm familiar with agriculture.
Oh yeah. Iowa State, so I played football obviously in college. We used to play them quite a bit.
Yeah,
one more question real quick.
Well, what is a house mother?
If somebody puts money into your organization, how is that accounted for? Where does the money go? Is it identified with specific properties? Is it is it investment in the organization as a whole?
Yeah.
And if somebody wants to take money out, what's the source of repayment?
Yeah. So these won't be, our fund is a separate practice. Each of these investments, what we're looking for is individual. They are one-off investments. Well, they're treated as limited partnerships per property. So we have a portal where you can view all of the properties that you've invested in, whether that's 5, whether that's 20. We can see all your properties, but they are individual investments. And because of that, you can liquidate your investment from, a number of those and without any consequence to us. We'll find the capital to make sure that, you can get whole and or, walk the investment to term. Yeah, that's perfectly fine. But yeah, they're individual investments. They don't sit in a one commingled fund, individual funds. So this 100,000 will be individual 100,000. Our next month raise at 500,000 will be, 500,000 is commingled together in that project, but they're all separate. So your accounting for tax purposes or whatever purposes will be, a string of individual funds. You'll be essentially a limited partner in a string of investments.
So you get a K1.
Investor gets a K1.
Yep.
So in this kind of deal, plan on getting an extension on your tax filing.
No, I think it depends on your other investments, but this is pretty straightforward.
So you have everything to them by the end of February?
Yeah, we'll have everything to you by the end of February, sooner than that. Our tax professionals and our fund administrator for Tintego is quick, snappy. You'll have your things usually by end of January.
Really?
Yes.
That's really unusual. Usually the CPAs are working on 1099s in January.
I don't think we've ever gotten any tax forms outside of January 30th. I don't think we've ever even delivered.
If you can really do that, that's way above average.
Yeah, that's amazing.
Yeah. Well, they cost a lot, so to get it done.
Well, we have people that don't get this stuff.
You always pay for good accounting one way or another.
Yeah, no, we do.
Right.
But we'd rather that. Again, it's, we're all invested in these as well. This is, the profitability of this is directly tied to myself. And I never wanted a point where I was trying to judge or figure out my tax obligation longer than 30 days. That was a hard, I think, floor for me for investing. I come from this as well. I came out of the NFL, so I think trying to find good operators or good fund managers or good investment managers was impossible for myself. I think that's a lot of how this started. The standard normal, the investment practice we have started is that it's hard to find good stewards of your capital. You're constantly looking and searching and doling out a little bits of cash to people who really don't see you as someone in the ship with you, but just someone they can extract value from. And it was impossible to me to try to find someone who would actually steward my capital and actually grow it. And it led me to kind of found standard normal 6 years ago.
Great. Well, I have a plethora of questions. So if anybody does have one, just raise your hand. In the meantime, I'll be asking them. Just just something that occurs to me is some colleges are extremely expensive to go to, and then you still have to do housing. Is that anything that you look at? Like Harvard is a very expensive college, for instance. Is that, do you take in what it costs for someone to go to school?
Yeah. So again, and my place in Boston is in Harvard Square still to this day. The cost of the college sometimes does not correlate to the cost of student housing. It's not a clear correlation like you would think. So, Harvard and other kind of private schools, you never get a really clear look at what the correlation between its actual price to go there and what students are paying, because a lot of times low-income housing students or poorer students will have scholarships or agreements with the university where they're not paying money. I think as a general rule, more private schools lead to increase in higher prices for student housing, but it's not always the case. So like places like University of Chicago, you wind up having, because they're in, so that's why I put on my slide again, I'll put that, the endowment data. We take a look at, and I'll share really quickly. Take a look at endowment data because so we take a look at, excuse me, endowment investment data because so a school like Harvard University has a $60 billion endowment. Now that endowment has an entire organization behind it that is used to invest. And understanding where they're investing is that in student programs to bring in more middle and lower class students or socioeconomic status students, is that going towards building on-campus housing, like where their money is actually going, it's an entirely separate practice. So, you know, University of Chicago spends, again, I think another $25 billion, like huge endowment. They spend a lot of time trying to find housing for students that could stay multiple years, you know, 1, 2, 3 years on campus. And so it honestly winds up decreasing the price in rents that are for directly adjacent student housing. So it's important to know how much, like private universities, how much money they do have and where they spend that money, like where they're actually giving that money out to. I'm sure, you know, Harvard in the early days in the 1800s, yeah, it was a more direct correlation. But now they do spend a lot of time trying to give that money out so that students are paying a lot of money. So it's just hard to understand for more private schools. But
got it, understood. David.
Yeah, hey Peggy. Thanks, Brad. I kind of came in late. I'm interested in this asset class. I've been looking into it for a little bit. Had a couple of questions. You're saying that you're focusing on single family residences, is that correct?
So we're focused on student housing in general near campus. Usually between 1 and 2 miles from major universities or from universities.
Okay, so you're saying
not necessarily single family. It could be, you know, multifamily housing.
Oh, okay. So are you buying them existing already with all the bedrooms, or are you creating those bedrooms when you buy the properties?
So we're buying existing. We don't, again, like my presentation, and I went into this a little bit in my presentation, is that we're not typically getting into, at least sub 1 million, we're not getting into value add. What we're doing is trying to target programmatically properties that are existing that have fallen below that fair market value for whatever reason. So for usually artificial means, distressed operators and or special situations. We like to call this kind of our special situations, you know, practice, but special situations that have pushed this thing down below fair market value. So what we're doing is just picking those and writing them back up. And then we're layering on top the modeling we've done for the universities for how many students they plan to increase or how many programs they're bringing in, that we know we can correlate to an increase because of the increased student population, an increase in rents specifically.
Okay, so yeah, I just want to understand. I thought you were saying you look at it single family residences, multifamily, but you're specifically looking for properties that have been existing. They were houses and of this nature, but you're taking over some sort of problems of the same type of industry, the same type of properties.
Yeah, we're buying existing homes, usually with very little wrong with them. Again, I think the situations is what are artificially pushing those properties down below that fair market value line. And I don't know if you saw that the slide that I had with the fair market value line. Did you see that?
Yeah, I saw that.
Okay, yeah. So that's again, it's just the special situations is what we're targeting. Those below that fair market value line. That
Gotcha.
Property, if anyone bought it at this price, it would raise, if anyone, it would raise back up, usually at least a 7 or 8% raise over a 7 or 8% IRR return over a 5-year period. And what we're doing is layering on top of that our quantitative gift, or our quantitative research. It says, okay, increase in student body population, more affluent students. This will push it even farther than that 7 or 8%.
Okay, so you're able to find these deals quite often?
We are, yes.
And
Honestly, especially now. We've kind of been waiting for the market to get to a place where it is now. I mean, we're kind of foaming at the mouth here to invest in more. This is, this is prime investment kind of territory for where the market is for what we do. It really is. We see so many. I mean, we see so many. That's where we want to get this kind of micro investment practice going so we can do these at more rapid clip. There are a lot out there.
So are your rents very similar to the ones that are close to the university that have all the amenities in them? I mean, are your rents very similar to those?
Say that one more time, I'm sorry.
Are your rents, as your comparables, are they similar to the ones that are closer to the university that have a lot more amenities, pools and, barbecue pits and all these kind of things?
Yeah, so usually our rents are, it depends on the type of property. So we usually compare our rents to what a fair market value or fair market rent would be for that home to a family. But if you want to compare student housing to student housing, we usually fall within the bin. We model a full bin of all standard rents, and we usually fall right in like the third quartile. So not the top, not the ultra luxe. We usually don't ever step there, but third quartile, we're right there. So the bulk of the distribution, again, we want to be, for what we do, we're targeting the things below fair market value. We want to be in the bulk of the distribution. We want to be able to garner the most students. We want to get the most eyes on that building so that we know our occupancy will stay, where it is. So again, we're targeting the bulk of the distribution, the major students that need housing.
Great.
Okay.
Thank you.
Okay.
Sheldon and then Jay.
Yeah, I just want to because I missed the first part of it, I was just wondering what's the return on investment? Is it a lockup period of 5 years? I'm just kind of pulling that, but I didn't hear that.
Yeah, so no, the term of investment. So this is, so I have it somewhere here. Hold on. So this is our projected hold time is 5 years. That's ideally what we see is a 5-year hold, probably around 20% IRR. There is no real lockup period. We structure our entity in a way that if people, and we keep our check sizes small enough that if people would like to exit out of the property, we leave room so that we can liquidate people out of their positions in our property.
Okay, awesome. And what's the minimum investment amount?
Minimum is 10,000. It should be on here somewhere. Yeah, minimum is 10,000.
Okay, awesome. Thank you.
Sure. We treat this, again, we started as a hedge fund, so we treat this like a hedge fund practice. We want this to be, and what we think is the more liquid we can make this, the more attractive it is for investors.
Is it a monthly payout or quarterly payout? Or?
It's a quarterly payout.
Okay. And where can I get the slides? Is that something that?
Yeah. So talk to Peggy. Peggy advises our fund, and so yeah, talk to Peggy. She'll give you all the information.
Okay. Thank you.
Okay. Sheldon, yeah, just make sure we have your email, and we'll make sure you get it.
Yep. Sent that already. Yep.
Great. Thanks. Jay.
Hi, thank you. Well, I guess it was nice that I made it here today, and I didn't hear the first part of the conversation. I was on another call, but I was curious if you're looking for people on the ground to find the kind of housing you're looking to convert. I'm in Tallahassee, and it's not what I do, but I see so many opportunities exactly for that right here. And I would love to work with someone if you need someone to help do that. I just enjoy doing it because I see so many opportunities here, and I don't see enough people doing it. The realtors are doing it because it's so easy.
Yeah.
Wow.
Yeah. We're always looking for stakeholders for what we do. Again, this is a programmatic play, and so if you think that you can find kind of top tier deals, then absolutely talk to Peggy. She can give you my information, and we can talk about something that'll work. Yeah, absolutely.
Yep, that'll be great. I made a note, Jay.
Terrific. Thank you.
Of course.
Sheldon, do you still have another question? Your hand's up. Okay, well, we're
Yes,
I'm sorry, Sheldon.
You said if that was the only question I had.
Okay, great. So I did have another question because you are using this and we're at the top of the hour. So after this question, we will stop recording. You use the word on and off campus often. So I am curious, if you are buying something on campus, do you also own the land, or are you in a lease, or is it just a term you're using?
No, so what I was referring to was that on campus, universities have on campus housing.
Right.
Usually, and all outside of, I think, one developer I know at Stanford in like the 80s or 70s, to build a building on campus and then own that building or even lease the land is near impossible to do. So no, on campus housing refers to universities housing. Off-campus housing or adjacent housing would be what we do. That's what we're looking for. I mean, I would love to negotiate with Michigan State or UCLA of hey, some building on campus that we could purchase, but I don't ever see that happening.
Well, I just wanted to have a clarification of that because people come up with some very interesting questions, and I want to be solid on that one because I could promise you somebody's going to ask at some point.
Yeah, we're all off campus housing. Again, very close, within usually 1 or 2 miles of the campus.
Yeah, where the kids could walk and not have to have a car.
Exactly.
Okay. Well, Brad, I want to thank you very much for coming on. This was very enlightening, encouraging. I had no idea about how many counties there were in the United States, so I learned something new on that. And this was a lot of fun. So we will let everybody get a hold of your deck or executive plan or whatever you're calling it, and let us know what they could do. And I'm also presuming that you take IRA money, self-directed IRA funds. Okay, great. That's good to know also. So thank you very much for coming on, Brad.
No, thank you. It was a pleasure meeting everyone. Again, thank you.